Hey guys, it's Max. How are you guys doing? Hey, this is a re-upload of my morning update or my midday update, but for some reason I forgot to share the screen. Or for the last half of the video, I wasn't sharing the screen, so I'm just talking, and it's a nightmare talking about stuff that you guys can't see. But I wanted to come on. It's a big day today, and I wanted to come on and talk about the YieldMax news. It's a big day in the covered call world because, is this it right here? I had it pulled up a little while ago, of course. All right, right there it is. Well, no, that's another YieldMax news. SMCI's coming, or SMCY. How did they not already have that? It seems like they should already. It seems like that would be one they would already have. Okay, well, anyway, but this was the big news. Distribution schedules are going to weekly. So this coming week, they're going to declare on the 18th. So what is that, Monday? 13, 14, 15, 6, 7, 8. I'm sorry. It's actually Wednesday. They'll declare next Wednesday. Pay on Friday for YieldMax, YMAG, and Alti. And then the next week, they'll pay for YieldMax and YieldMag. And then YMAX and YMAG are every week. And then they're starting to rotate they've split their ETFs, their normal ETFs, up into 4 different groups, and they're going to rotate through those. So ideally, you can use these to get weekly updates. They made a synthetic weekly update if you have a pretty good selection of some of their funds. Say if you have GUI, FIBI, Coney, and Misty, which is a pretty common mix, or say you have Coney, Misty, and Vidi, Tesla, which is a pretty common mix. You know, you get you have the inverses paying on the same day as their bullish fund, the same cycle. And I think it's exciting. I guess, I mean, I don't know. YMAX and YMAG going to true weekly is kind of crazy too. So here's what else I would say. One of the themes of this channel is there's no free lunch, especially not on Wall Street, and not especially when you're trading, either when an institution's trading for you, like these ETFs, and then and giving it to you as an ETF package, or when you're trading yourself, there's no free lunch. And when a broker does something for you, or an institution on Wall Street, they're charging you somewhere for it. I haven't even read the prospectus yet. This has a prospectus change. I didn't even look through there to see if they raise the expense ratio. And I don't think they will, but I think they'll hide the expenses will still be in here. This is going to be more expensive to do. So, I mean, that's what I would say to it. There's a cost for everything. So a lot of people say the weekly compounding is going to make up for it, because you're going to be able to compound weekly. Well, I ran a compounding simulator, and it makes less than 1% difference. I mean, it helps. I mean, 0.75%, rolled forward over 30 years can make a difference in your portfolio. I'm not saying it's nothing, but it's not, to me, it's not the be all and end all. But anyway, YieldMax kind of did a good thing here, because they made YMAX and YMAG true weekly if that's what you want. Or if you want to pick and choose, you can probably have weekly if you can choose one off each list. Or maybe you already have a couple off 2 of the list. You can choose a couple of the other ones, and then all of a sudden you've got a synthetic weekly. And I mean, that is a genius marketing deal. And maybe that didn't cost them too much more money to do. I don't know. But I mean, money's not the only thing. And I'm not saying they're going to charge a ton and hide it in here, and it no longer makes these good investments. I'm not saying that, but I'm saying there's a cost for everything. This is nice. There's a cost for everything. I mean, how much do you think it costs Roundhill to pay weekly? Because Roundhill pays their dividends only about half as much. Now, we know, though, if you watch my channel, it's only half as much because of the timing of when they sell the option. But they do have an extra expense that's also built into there somewhere. And I'm not talking about the published expense ratio. They can publish the expense ratio at whatever they want. And then you'll still, even with trying to think, they tried to get better on having Wall Street firms not be able to hide stuff. I mean, but I know back in the old days, and this knowledge is 30 years old, everything was hidden, and whenever they say it was there used to be no load mutual funds. Those were the most expensive mutual funds. Anyway, times are different. This is 2024. All right, guys. Well, anyway, it's good news. I mean, it's good news from a marketing standpoint. If you like it, it's good news. And it's good news if you have YieldMax and YMAG. Even the weekly compounding is not nothing. So I didn't mean to imply that. But my point I'm usually trying to make with the weekly compounding, to me, the weekly compounding doesn't make Round Hill better than Defiance. Because it's only going to make up a little less than 1%, and they only pay about half the dividend. So it's not like they make it up. Now, Round Hill's genius is they make it up in up markets, because in up markets they get a lot more total return. So I'm not saying there's no case for Round Hill either, but it's the weekly compounding is not the case for it, in my opinion. But I could see how this gives people, a lot of people that are doing these right, in my opinion, are using these dividends to go into other investments. And the fact that you now can get weekly dividends, you can spread out the timing of your other investments. Lots of the strategies I recommend are taking the dividends and then buying the underlying. Well, if you buying in other words, taking Tesla dividends and buying Tesla with half of them. And that virtually eliminates any type of erosion problems you have or upside problems you have. But in any event, if you did that 4 times a month instead of once a month, it would cut down on path dependency. So what's path dependency? Path dependency is the day that you get the dividend, you're going to reinvest, right? I mean, in most cases, so you're kind of locked in on your full amount for that month. But if you get 4 different dividends and the market's, you get a better average performance is the idea. You get more diversification in your entries. So anyway, it does have good tactical use cases as well. So other than there probably some hidden cost in here somewhere, maybe I can't think of a bad case for it. Okay. Well, also I screwed up the Defiance update. So I'm going to update Defiance real quick. If you guys don't want to see that, you can get out of here, but we're just going to look at the spreadsheets and we'll look at the buffer report and see what's going on right now. Let's start with JEPY. These guys are up. I'll try to be quick since I spent all the time talking about YieldMax going the dark side. These guys sold options for $25. Right now they could buy them back for nothing. So full profit, 462,000. Brings these guys to down 31 cents a share on the month. Dividend estimate's $2.59, which is 72.2%. All right. Triple QY. All right. Triple QY. All right. Triple QY sold options for $118 that are out of the money. So that's good since they sold them. So they're realizing a $1.2 million profit. Brings them to even on the month if they can hang on. So that's pretty good. Dividend estimate is $2.74, which would be 92.5%. All right, IWMY is, I usually say the strongest or the weakest, and today it's earning a full profit. They sold options. So, I mean, let's see here. Yeah, they're killing it. Look at this. Look at Russell just blowing up today. Anyway, you're definitely full profit because outside of the profit box is a full profit. We'll look at the other ones real quick, and then we'll look at USO. Look at this one. NASDAQ just blowing up way out of the profit box. Then we'll look at SPX. Same story. Now, also, SPX and NASDAQ have both taken back the 200 period moving average on this chart that I follow, this 30-minute time period chart. Well, anyway, it's a 200 period. It's a pretty good way to separate bullish from bearish. Well, anyway, NDX and SPX just went over the 200-day moving average. So assuming it stays over the 200-day, prices should generally trend up. Not always, though. We'll see. And it could be a fake out. It could go tomorrow, could be right back under and dropping. I mean, there's nothing magic about a line on the chart, but it is something to be aware of, right? All right. So now let's look at USO. Notice I have the same technical indicators on all the charts, which is just the 200 period moving average and the Bollinger Bands. And I have special settings on the Bollinger Bands, but I think that's all you need. But anyway, oil is getting some bullish momentum today. It opened and blew up, and we're outside of the profit box, but we dipped right back into it. The good thing is these options don't expire until tomorrow. The bad thing is tomorrow's Friday the 13th, right? See, I drew this box out a little too far. Let's see, right there. Okay, so we have, we just got to keep it inside here or above here for max profit. Oil's been kind of hurting us lately. USOI has, what was the dividend last month? $1.05. I'm looking at $1 this time. I know my estimate was way off, but I think I figured out why, and have a different methodology, but anyway, or a different way of figuring it. So we'll see. But these guys have the 70 strike sold for $2.30. But basically, when you look at this, that's what you're seeing visually. The top line is at 70. The bottom line is $2.30 away from 70. So it's down at 67, 70. Anyway, so that gives you an area that shows you how big of a target you have named for. It just can't go out of this area. It can go above it. It just can't go below it, out of it. Okay, so that's great for that one. Now let's look at the buffer report. We have several buffer reports. Is this one? No, that's not one. Okay, chart 11. I think iSpy is broken. It doesn't update live, so I meant to take that out. My bad. All right, SPY-T, almost outperforming the parent. JEPY getting 0.5%. That's pretty good. JEPY or SPX getting 0.7%. So what is that? 5/7. 5/7 is an easy fraction. For some reason I can't think of what it is right now. But anyway, that's a pretty common fraction. It's like 68%. It's not 68%. 70. I don't know. Anyway, it's getting part of the upside. Now, SPY-I is getting even more of the upside. You want these ones to get, all of the upside and then some. Like, look at KQQQ. All of the upside. It's tied with the benchmark. Look at triple QT, the Defiance badass target fund. So what the target fund does is Jay's figured out a way to uncap the upside. These target funds no longer have capped upside. They're still covered calls, no longer capped upside. So it's kind of the best of both worlds. The trade-off is they only pay 20% dividend instead of paying similar funds that trade similar options pay 50 to 60%. Okay. Anyway, that fund's killing it today. Triple QT is up more than the benchmark, which is the NASDAQ, and that's saying something. Now, QDTE is a good fund also and catches a lot of upside. It's not up quite as much as the NASDAQ today. Now, triple QDTE has an interesting chart or an interesting path dependency feature. And the path dependency that they profit from is a morning gap up, and they actually did not get it. In fact, they got a little gap down. The market closed at 55.55 and opened at Well, 55.52. That's not, is that right? Oh, no, that's the close. 55.52 is the close. The open was, oh, no, open's 55.57. No, so it shouldn't have any effect. It didn't get a gap down. But on days they get a big gap up, like this day, that's a huge benefit to their NAV. The entire gap goes straight to their NAV. So they get a lot of upside too. They kind of have the system hacked. So that's great for those guys. All right, so let's go back here. Let's see what else we have to talk about. YieldMax is sucking, but I mean, YMAG looks good. QYLD looks all right. Get about 60% of the upside. Now look at the Goldman Fund, GPIQ. A lot of people think this is one of the better funds, and I think rightly so. GPIQ and JEPQ are some really good funds. As is, though, Triple QT. I'd put Triple QT against any of them. And Triple QI is a good fund, too. All right. Anyway, JEPQ, but seriously, these funds are great funds. JEPQ and also Triple QI said this fund right here is a good Spy Eye's brother. And it's a very reliable fund. All right. ULTY. ULTY is either up the most or down the most on almost every day. Today it's up the second most. Look at ULTY is even behind the Triple QT. Triple QT is killing it. That uncapped upside, see, that's when it comes in handy. That's when it matters that you sell a call spread, is when the market's blown up. And what happens to the S&P? Well, it always blows up. So, so it's a great strategy. Now, what else happens here? Or I shouldn't say it always blows up. In a bull market, it tends to do that. And it's the same thing. What else does it tend to do in a bull market? It tends to gap up overnight. Well, that's also a benefit that's a path dependency benefit to the roundhill strategy. Wonder if some fund came out and combined the two strategies. Did the call spread with the next morning's override? The problem would be that fund would only make about half of what Roundhill's making, which isn't that much. It wouldn't get a lot of these high yield investors excited, but you could theoretically do a morning call spread fund. But anyway, if that was the case, you could theoretically do anything nowadays that commissions are basically free. We've seen a lot of gamification of securities, but I think the options world and the derivatives world, despite sometimes being gamified a little bit, presents some really, really fascinating tactical investment opportunities, and not the least of which is these covered call funds. Okay, so let's see what else we got going on. Well, USOY just murdering it. When I looked at their chart, it looked good, but I didn't. Well, yeah. Oil's bouncing back. So when oil bounces back, the market bounces back. They usually go the same direction, or lots of times they do. When the oil's going up, it generally means the economy's going and expanding. And I guess, just to a little bit, when oil's rising gently, it's you don't want oil to suddenly go up, shock the system. But all right, and the other thing that really controls the market anymore is Bitcoin. And look at it, it's breaking out. And it's looking bullish. Let's step back here to the daily time frame. I'll have you guys notice, even on the daily time frame, I keep the indicators the same. So that way I always make an apples to apples comparison. So the red line is actually the 200-day moving average, because these are daily bars. Okay, now that separates bull market to a bear market, in my opinion, or it's one thing that does, but it's a pretty good indicator. You don't have many bull markets that take place below the 200-day moving average, not for long, maybe, let's just say. But but Bitcoin has been under the, went under the 200-day moving average back here in August, right when the market cracked, dropped through it bad, but then it rallied back and it can't even take back the 200-day moving average. Now it's going back up right here. But anyway, so that's, definitely that definitely has not helped. That has not helped the NASDAQ. Now, the NASDAQ, on the other hand, is stronger than Bitcoin because it, even in the August pullback, it got under the 200-day for a day. And then it, the bear market didn't happen there because it bounced at the 200-day. As long as it bounces at the 200-day, no bear market. Well, guess what happened in 2022? No bounce at the 200-day, right? And we stay underneath it for January 22nd to February. We stay underneath the 200-day for a full year. Is that right? That almost seems like that average is too long. I think maybe I switched the settings on that. But anyway, this, you can see, the 200 days is a great way to determine bull markets. No, that's it. Bull markets, bear markets. So I look at everything on that basis. So you can do the same thing in a shorter time frame. When you're trading daily and weekly options, you aren't worried about that long of a time frame. This 30-minute time frame is more pertinent to what you're trading because you're trying to get in now and out tomorrow morning, right? It in today and out Friday or something. You're catching the quick pops, and so you turn on the shorter indicators, but you can see in that shorter time frame, hey, are we having a bull market or a bear market in the shorter time frame? So back, in July, we started having a major bear market in the shorter time frame. And then we popped all the way through to August, still under the 200 period moving average in the shorter time frame. It's, no way you'd want to be long in this time frame, right? No way. Anyway, and until it takes back the 200-day, right there on August Tuesday the 13th. Anyway, it's not the be all and end all, but the 200 days is one of many things to look at. All right, guys. I hope you like that impromptu technical analysis lesson, and I hope you're happy with the YieldMax. Let me know what you think. I wasn't trying to shit all over it. I tried to make some good cases for it. The tactical cases, the cases where having the weeklies cuts down on a path dependency. I think there's some great use cases for that. So we'll keep an eye on these guys and we'll see what they do. They'll keep bringing out new stuff. All right, guys. Take care.